You felt it at the gas pump. You felt it at the grocery store. You felt it when your mortgage statement arrived and the number was higher than you expected. And if you're like most Americans right now, you feel it, but you can't quite explain it. Here's the explanation. 3 weeks ago, a chain reaction started 7,000 miles away, and the final link in that chain is sitting in your wallet. In the next 10 minutes, I'm going to show you exactly what happened, why it's hitting your money right now, and 7 specific moves you can make before the next wave arrives. Because the people who came out of the last inflation crisis stronger weren't the ones who panicked. They were the ones who understood the chain before it became a headline. Let's build the chain. On February 28th, the United States and Israel launched coordinated strikes against Iran. Within days, Iran responded, and the Strait of Hormuz, the narrow passage through which 20 million barrels of oil flow every single day, effectively closed. Now let me give you the human scale version of what that means. Imagine the entire U.S. food supply flowing through a single 2-lane road. Now imagine someone put a roadblock on it. That's the Strait of Hormuz, and it's closed. Before the war, Brent crude oil was at $65 a barrel. 3 weeks later, it was past $100, a 40% increase in less than a month. And projections, if the strait stays closed, suggest $150, maybe $170. What does that mean for you? Every delivery truck costs more to run. Every flight burns pricier fuel. Every product shipped to your local store carries higher transportation costs. And those costs don't just disappear. They get passed directly to you, at the checkout line, every single week. But here's what almost nobody is talking about. Oil is just the first shock. There are 2 more building quietly in the background, and they might be worse. Shock number 2, helium. I know, you're thinking birthday balloons. Stay with me. Qatar operates one of the largest helium production hubs on the planet. Recent attacks have taken roughly 1/3 of global helium supply offline. And helium is not optional in the modern economy. Semiconductor manufacturing requires it. MRI machines run on it. Without a steady supply, chip production slows or stops. And without chips, your phone, your car, your hospital, all of them start running slower. Shock number 3, fertilizer. The Gulf region supplies critical fertilizer inputs, urea, ammonia, sulfur, the building blocks of modern agriculture. If that supply is disrupted, farming output drops. And when farming output drops, your grocery bill in 6 months looks nothing like your grocery bill today. Now put it together. Expensive energy, disrupted chip supply, tightening fertilizer inputs. 3 foundational pillars of modern life all under pressure simultaneously. Most people only know about the first one. The second and third are building quietly, and by the time they show up in headlines, they'll already be in your grocery bill. There's a word economists have started using quietly. They're not shouting it yet, but the whisper is getting louder. Stagflation. High inflation and a slowing economy happening at the same time. And it's one of the hardest situations any government can face, because every option comes with a cost. Raise interest rates to fight inflation, you risk crushing economic growth. Lower rates to support the economy, inflation spirals further. Do nothing, the market makes the decision for you. We've seen this before. Between 1979 and 1980, during another Iran-related crisis, oil prices surged, interest rates climbed dramatically, and markets struggled for years. That's the comparison analysts are starting to make today. And here's the problem. Even before this war, inflation was already running above target. There was very little room to maneuver. Now, with energy prices rising, the Federal Reserve is trapped. Earlier this year, markets expected rate cuts in 2026. Now, no cuts. The earliest possibility has been pushed further out. Consumer confidence is already slipping, and the damage is already building before we get to the solutions. Let me address the thing that confused a lot of investors.
Gold dropped. When the strikes began, gold initially ticked up. Then it fell sharply, more than 6% in just a few days. If gold is supposed to be the crisis hedge, why did it drop? Here's the mechanism. An oil shock forces central banks to keep rates higher for longer. Gold doesn't pay interest, so when bonds and savings accounts start offering better returns, gold becomes less attractive in comparison. At the same time, the dollar strengthened. A stronger dollar makes gold more expensive for international buyers. Demand drops, price drops. But here's what that actually means to you. Gold didn't break, the setup improved. Major institutional investors still project significantly higher gold prices by the end of 2026. The World Gold Council recommends a 5 to 10% portfolio allocation under normal conditions. During periods of heightened geopolitical risk, that allocation typically increases. The drop isn't a warning, it's a window, and windows don't stay open forever. Here are the 7 moves. Let's go fast. Move 1. Build your cash cushion first. Before any investment strategy, before any market move, 3 to 6 months of living expenses in accessible cash. This isn't lazy money. In times like this, it's what keeps you from making panic-driven decisions that permanently damage your long-term savings. Cash cushion first, everything else second. Move 2. Organize your cash by time horizon. Money you need in the next 30 days goes in a checking account for immediate access. Money you won't need for 1 to 6 months, put it in a high-yield savings account. Earn something while you wait. And money you don't need for 6 months to 2 years can go into short-term treasury bills. They're currently paying real returns and are still safe. Don't leave cash sitting in a checking account earning nothing while inflation eats it. Move 3. Don't panic sell your long-term investments. When your retirement account drops, every instinct says act, protect what's left, get out. That instinct is expensive. Selling during a panic locks in losses that might have been temporary. It turns a paper decline into a permanent one. And when the market recovers, as it historically does, you're no longer in position to benefit. The investors who panic sell during a crisis are usually the ones who miss the rebound. Selling near the bottom, buying back near the top. Don't be that person. Move 4. Consider inflation-protected securities. Tips. Treasury inflation-protected securities. These are government bonds whose value adjusts with inflation. As prices rise, the value of the bond increases. In a world where inflation is elevated and central banks are limited in how aggressively they can respond, tips become especially relevant. Large institutional investors are already allocating to them, even accepting lower returns in exchange for reliable inflation protection. That tells you something about what they expect ahead. Move 5. Build gold exposure gradually, not in one panic move. Use dollar-cost averaging, small amounts, consistently, over time, not one big move during a moment of crisis. Think of gold less as an investment and more as insurance. You don't buy insurance expecting disaster. You buy it because if something goes wrong, you want protection in place. A 5 to 10% allocation isn't panic. It's an acknowledgement that uncertainty is real. Move 6. Shift toward defensive sectors. Not all parts of the stock market react the same way in this environment. When energy prices rise and growth slows, healthcare holds up. People still need medical care regardless of economic conditions. Industrials and materials can benefit from certain shifts. Energy-related investments have already seen strong gains. Dividend-paying defensive companies don't skyrocket in bull markets, but they also don't collapse when interest rates stay high and growth slows simultaneously. For anyone nearing retirement, this isn't just cautious thinking, it's necessary. If you don't have 20 years to wait for a recovery, your strategy has to reflect that reality. Move 7. Prepare your household budget for higher costs and eliminate variable rate debt. Plan your energy, food, and transportation costs at higher levels than last year, not what things used to cost, what they're likely to cost going forward. Variable rate debt, credit cards, adjustable rate mortgages, these become especially dangerous when interest rates stay elevated. Paying that debt now protects you from watching your interest payments grow month after month. And review your monthly subscriptions, insurance policies, automatic renewals. In times like this, every dollar you redirect matters. Here's what I want you to actually hear underneath all of this. You are not powerless. You are not behind. You are not someone who has to watch this happen to them. The people who came out of the 1970s oil crisis stronger, the ones who built wealth during stagflation while everyone else was paralyzed, they weren't smarter than everyone else. They weren't richer than everyone else. They just understood the chain before it became a headline. They knew that oil shocks don't stay in the oil market. They flow